Assalamualaikum and salam sejahtera. Hi everyone. So this video is prepared for the introduction to accounting. Okay. So there are three subtopics under this topic one. Okay, which are definition, functions, objective, and users of financial statement. Okay, main user groups of financial statement, right? Types and various form of business, and the last one is differentiate between bookkeeping and accounting. Okay, so now let's look at the learning objective. Okay, so the topic outcome, okay, it is expected that students should be able to explain definition, functions, objective, and uses of financial statement. Okay, and then to identify different groups of users and their use of the financial statement, to explain the different types of business, okay, to differentiate between accounting and bookkeeping. Okay, right. So let's look at the definition. Okay, so let's look at the definition of accounting. Okay, there are so many definitions of accounting, and then one of the definition of accounting is that the accounting is the art of classifying, recording, and summarizing transactions and business events in monetary terms, and interpreting the results to interested party to enable them to make decisions. Okay, when we talk about accounting, it is common that people think that that the accounting deals only with the recording process, but it is not. It started from the classifying. Okay, why it is said that it is the art of classifying? Because to classify, you need to understand um, the classifications in accounting. Okay, there are asset. Okay, there are revenue, there are liability, there are expense, and there are equity. So every time a business transaction happen, we should be able to classify them accordingly. All right, and then we proceed with the process of recording. Okay, and then after the recording, then we summarize all the transactions, and this summarizing the transaction is called the financial statements. All right, it is called the financial statements. All right, and then however, okay, the work of people, okay, who uh, who is in accounting line, okay, usually uh, does not stop at summarizing the transaction into the financial statements, but we also need to interpret the results. We need to interpret, okay, whatever that we have on the face of the statements. All right, interpret the results to the interested party so that they are able to make a better decisions. They are able to make an informed decisions. Okay. All right, so that is the definition of accounting. Basically, it is a process. Okay, it is a process from the classification of the business transaction into asset, into liability, into equity, all right, into revenue or expense. All right, after the classification, then we record. We start with the journalizing the transactions in the journals, and then we post to the ledger. Okay, so maybe we can see the next slide, okay, for an accounting cycle, or other names is the accounting process. Okay, all right, so basically this is the process in the accounting. Okay, the process in the accounting, okay, where we start with the business transaction itself. The transaction must happen, okay, and then for us to record. If the business transaction is not there, okay, if it does not happen, then we have nothing to record. Okay, when there is a business transaction, usually from the transaction, okay, we are going to have a source document. For example, we are going to receive a receipt, okay, or we are going to issue any invoice, okay, for the transaction. All right, so all of these document will be kept, all right, and then will be classified into its classification, all right, into the accounting classification. Okay, and then it will be journalized in the journals. All right, so later on you are going to see the different types of journals. Okay, and then from the journal, okay, we are going to post to the ledger. Okay, and then from the ledger, we are going to take all the balances that we have prepared in the ledger, and then we're going to prepare a trial balance. Okay, if we need adjustment, okay, if we need adjustment, okay, then we have to journalize the adjustment, go to the third process again, journals, okay, and then ledger, re-prepare the trial balance. Okay, when there is no more adjustment to be made, only then we prepare the financial statements. All right. Okay, so next. Okay, so this is an example. Okay, examples of accounting cycle or accounting process. Okay, from the sales receipt. Okay, from the sales receipt. Okay, we record in. We transfer sales receipt, meaning that you make sales. Okay, you sold goods worth 200 for cash. Because of this transaction, you sold something to someone. All right, so you give him or her a receipt. Okay, so you state clearly on the receipt. Okay, buku tax, for example, amount 200,000. Amount 200 ringgit. Okay, and then it will be transferred, it will be journalized in cash receipt journal. Okay, and then from the cash receipt journal, you are going to post to the ledger, okay, which is the account. All right, so to the sales account and also to bank account. Okay, all right, so next. Okay, so the end of accounting cycle, we have financial statements. Okay, so why do we need to prepare this financial statement? Isn't it enough? Isn't it enough for us to only prepare the duit masuk and duit keluar? Is it enough? All right, no. We have to go through all the process of accounting cycle until the preparation of financial statements. But the question is why? Okay, the objective of financial statements. Okay, so to answer that, we look at the objective of financial statement, which is to provide the information about the financial position, okay, the performance, and also the cash flow of an entity that is useful to those users in making economic decision. Okay, because we need to know about the financial position, we need to know about our business performance. Are we doing good? Are we doing bad? All right, and then how much money do we have left in our account? What are we using that money for? All right, so by preparing the financial statement, only then we can answer this question. Okay, all right, and then the purpose of and then what about the purpose of recording, okay, and analyzing the accounting information? Okay, number one is, of course, like I explained before, to know the financial status of the company, whether the business is making profit or loss, and then to take the corrective action. Okay, after we have identified that, oh, we are making losses, so we have to do something. Okay, we have to do something. We have to correct something. Okay, okay, we have to take corrective action. All right, and then another purpose of recording and analyzing the accounting information is to serve as a reference by the user of accounting information. To serve as a reference. If you need to refer to something, then we have the record. We have a proper recording process. Okay, and then the recording process is required. Yes, it is a very long process. From the source document, you have to journalize the item, and then you have to post to the ledger, you prepare the trial balance, you make adjustment, only then you prepare financial statement. So why? Because we want to make sure that the financial statements that we prepare is of a good quality, okay, without any error and omission. Okay, and then when we give the financial statement to someone else, for example, if you ask for a bank loan, you have to give your financial statements to the bank, so the bank can make a better decision using your financial statements. All right, okay, right, next. Okay, again, okay, this one I only share with you the excerpt from the Malaysian Accounting Standard Board, okay, Malaysia Private Entity Reporting Standard, or in short MPERS. So when we prepare all of this, we did not prepare as we like, but we refer to the standard. Okay, all right, next. Okay, so this is a purpose, okay, from as stated in the Malaysian Accounting Standard Board, okay, MFRS, the presentation of financial statement. Okay. So now we are going to look at the users of financial statements. Okay, when we prepare the financial statements, okay, why do we prepare? Because we need to make a decisions. Okay, so who wants to make the decision? Okay, who are interested in the financial statements? Okay, so we classify the user into internal users and external users. So for the internal users, the people that are interested in the financial statements are of course the owner, because they want to know whether they are making profits or they are making the loss. Okay, so, and then the manager. Okay, the manager who works for the company, who works for the business, they need to know also the financial position, the financial performance, because they need to take any corrective action. Okay, they have to act quickly, they have to act appropriately. Okay, and then for the employees, okay, for the employees, they need this information because sometimes their bonus, for example, okay, their benefits, for example, depends on the financial performance of the company. And then sometimes they need also to know about the financial position of the company, because they need to analyze the stability of the company, of the business, whether to stay or whether to leave. All right, or maybe they can ask for more. Okay. Alright, what about the external users? Is there any other person, okay, who are interested in a financial statement? Of course, okay, we have external users, for example, the payable, the banker, the creditor. Sometimes when we own a business, and then when we make a purchase, okay, when we make a purchase, we purchase on credit. We ask for a we ask for a delay in the payment. Okay, we ask for a deferment. Okay, so they are of course will ask for to look at our financial statement. Okay, they need to look at our financial statement, okay, to make a decision. All right, whether to give you loan, okay, whether to give you credit. Okay, and then for a company, okay, for a company, especially the public listed company, okay, they have the investor. Okay, so they have the investor. Okay, so the current and potential investor would like to know about the potential, about the business potential, about the sustainability, whether the business can sustain in the future or not. Okay, whether they should buy the shares of the company, or whether they should sell the shares of this company, or whether they should hold the shares of the company and do nothing. All right, because it gives them more benefit in the future. All right, and then a government, of course, would be interested in our financial statements, in the businesses financial statements, especially the government agency like Inland Revenue Board, because they want to know because they want to prepare budget. Okay, they need to know their income in the future. Okay, and then consumer. Okay, for the consumer, sometimes they are also interested in looking at the financial statement. So consumer here, you don't have to look at the individual level. Consumer can be another business. All right, another business buying something from another business. Usually when they consume something, because they are producing something. Okay, let's say for example, you are you are a baker. Okay, you bake cakes. Okay, when you bake cakes, you buy a very good quality ingredients. Okay, so you want to maintain the same quality of ingredients that you use. Okay, but what happen if let's say for example, one of the ingredients that you use, okay, the supplier of the ingredients is no longer in the business? What do you think will happen to your business? It will affect your business. So that's why for the consumer like this one, they prefer to look at the financial statement, because they want to analyze. Okay, because they want to analyze whether um, whether they can they want to analyze whether they can continue buying the same ingredients or not in the future. If not, then they have to change, okay, the supplier, but without jeopardizing the quality of the ingredients. Okay, all right, so let's look at the next one. Okay, in the next slide, okay, I explain again how the users of the financial statement use the financial statement. Okay, Okay, so in the next topic, we are going to talk about the various types of business organizations. And then for this course, we are going to focus on the three types of business organization, which are sole proprietorship, partnership, and limited company. There are many other types of business organizations, but we focus only on these three types of business organization. So now let's look at the different characteristics of the business organizations. So what are the characteristics of sole proprietorship? Okay, in terms of registration, it is registered with Business Registrar under the Business Registration Act 1957, and the capital contributed by the owner alone. And then, of course, the ownership is owned by only one person, which is the owner. All right, while the management and control, okay, managed and controlled by the owner himself or herself. Okay, in terms of liability, okay, it is unlimited liability. All right, so I will explain later what does it mean by unlimited liability and limited liability. Okay, what about the profit or loss? Okay, profit are enjoyed while the losses are suffered or borne by the owner alone. All right, and then for books and accounts, okay, for sole proprietorship, there is no legal obligation, no legal requirement to keep and prepare the accounts. Okay, so we're going to look at the partnership in the next slide. Partnership. Okay, so in terms of the registration, it is registered with Companies Commission of Malaysia, CCM or SSM, under Business Registration Act 1956 and 57. Capital contributed by the partners according to the Partnership Agreement, okay, or Partnership Act 1961. In terms of ownership, okay, now we have different types of partnership. We have general partnership, okay, from 2 members to 20 members. Professional partnership like doctors, architects, engineers, okay, surveyors, okay, they can have unlimited partners. Okay, they can have unlimited partners. So that's why sometimes we see the same architect firms across the country. Okay, is it running by one person? Okay, not necessarily. They have different partners. Okay, running by different people. Okay, of the same partnership. All right, and then we have now limited liability partnership. Okay, limited liability partnership, which is different from the general partnership. Okay, and the number of members 2 to unlimited partners. All right, what about the management and control? Basically, it will be managed and controlled by the partners. All right, liability. Okay, for general partnership, the liability is unlimited. Whereas for limited liability partnership, as the name is, so the liability is limited. Alright, in terms of profit or loss, it depends. Okay, how you want to share the profit, how you want to distribute the profit, share the losses. Okay, it can be based on the partnership agreement as agreed when you set up the business, or as per Partnership Act 1961. Okay, if you have no partnership agreement, if there is an argument over the profit or loss among the partners, then we are going to refer to Partnership Act 1961, which usually state that the profit or loss are to be shared equally among the partners. Okay. Okay. For books and accounts, there is no legal obligation again, yeah. Like sole proprietorship, there is no legal obligation to keep and prepare the account. Okay. So now let's look at the last one, limited company. Okay. For a limited company, okay, the characteristic are very much different from the sole proprietorship and partnership. Okay, in terms of the registration, okay, it is registered with Companies Commission of Malaysia, but okay, a limited company is put under Companies Act 2016. Alright, for capital. Okay, the capital is contributed by shareholders through the purchase of shares of the company. Okay, and then in terms of the ownership, the private company may have one member only, but limited, okay, to 50 members, okay, who are also the shareholders of the company. Alright, for a public company, because they offer their shares to the public. Okay, so the number is from one member to unlimited number of shareholders. Alright, in terms of management and control, unlike the two previous business organization where the owner or the partners, okay, manage and control the business themselves. Okay, but for the company, the management and control, okay, rests on the shoulders of the board of directors who are being appointed by the shareholders, okay, usually in a meeting. All right, and then the liability, okay, as per name of the company, which is the limited company. Okay, so the liability is also limited. All right, okay, whereas for profit and loss, okay, only profit will be distributed to the shareholders, while the losses will be recorded in the company and will reduce the previous profits of the company. Okay, and then books and account. Okay, for a company, okay, any types of company, they are required to prepare proper books and account, okay, which must be kept and sent to the company's commission of Malaysia. Okay, so in the next slide we are going to look at the difference between limited liability and unlimited liability. What does it mean by those? All right. Alright, okay, so unlimited liability means that if the business fails, okay, fails to pay the debt, alright, and the business asset are not enough to cover the debt, alright, after they sold everything, they still don't have enough money to cover the debt. Okay, the creditors or the payables have the right to take, okay, or to seize the owners or partners' personal properties to settle the business debt. Alright. Compared to limited liability, if the business fails and the business assets are not enough to cover the debt, the creditors or the payables do not have the right to take or to seize the shareholders' partners, okay, partners' personal properties, okay, to settle the business debt. Okay. Okay, and then we have one more slide here, bookkeeping versus accounting. Okay, this is to answer the last one, the difference between bookkeeping and accounting, which I already explained also previously in the first slide, okay, on the definition. All right. Okay, so bookkeeping, okay, is the process of classifying, recording, and summarizing. This is what people usually imagine of the work of accountant. But, okay, accounting itself goes beyond that. All right, we do not stop at summarizing, but we also interpreting the results. Okay, interpreting the result to the interested parties so that they can make a better decision making. Okay, all right. All right, so that's all for topic 1. Thank you. So if you have any question, you may ask, and then I will try my best to answer any question.